Well, great. Thanks everyone. Thanks everyone for joining. Happy Wednesday, and I hope everyone's been having a great conference so far. And I'm really glad to be here for you all to just help discuss spinning out your company from a university and strategies for funding that effort. Uh, it's been a great opportunity for me to speak to you all. I think we're still waiting for my video to come in, but I'll keep talking. Okay, that sounds like I'm in. Okay, great. Well, I think everyone heard me but couldn't see me. So thanks for joining. Um, so, first off, a couple administrative tasks. We're going to be doing some polls, and I think Lauren should be bringing those up shortly. And also, if you have Q&A, there should be a Q&A section that's to the right of your screen somewhere. I'm not seeing the same thing you all are. It's a new platform for me, so I hope I can figure this out in our virtual world of all these permutations that have popped up. Uh, I do encourage everyone to ask questions, and I'll be having them fed into me in the chat, on my chat on my side. So I hope I can answer them as we go, and also bring in some of the data from the polls that popped up. So I wanted to, take this opportunity to let you all know what I've learned over several years of investing in startups that spin out of universities, and hopefully help you all figure some questions out that may have been popping up in your mind over your past years of thinking about starting a company. Just quick background on me. I'm a Princeton alum. I was a graduate student. I finished up in '09 in the mechanical and aerospace department. And then I went to work for Lockheed Martin for several years, about 7 years, doing early stage R&D, mostly DARPA projects across a broad range of applied physics topics. I worked with a lot of universities there. And then about 6 years ago, I joined Osage University Partners. And I don't want to dive too deeply into this, but we've been, as a venture fund, investing in university spinouts since about 2009. And it's our exclusive mandate. It's what we do. And we do it across a range of sectors from life science to tech. And I tend to focus on tech given my background, but I have a really close connection with our life science team. And so if any of you have questions on the life science side, I'll do my best to answer them. I can always connect you with someone else from our team as appropriate. My email is on our website. It's also going to be at the end of this presentation if you want to write it down. So let's jump in. Some of the things that I wanted to cover today about starting your company is I'm breaking it down into three areas. How do you approach investors? And these are investors of all types, friends and family, non-dilutive investors like NSF, SBIR money, all the way through big venture capital investors and corporate investors. But then also setting your company up for success. Like, what are some of the things that you can mess up on day zero of starting your company? And most of this comes in founding the company and share. How you think about starting a company with co-founders of all different commitment levels, as often happens at universities where there's graduate students and faculty and postdocs involved. And lastly, just some early kind of quick discussions on what matters to investors and what we look for when we're evaluating companies. So, with that, let's talk about approaching investors. Um, I think this is easier said than done, but it's really important to know your audience and plan your presentations or your grants or your proposals, as you all know, and come from the university environment, to who you're speaking with. And it obviously is most helpful when you know the group or person involved, but sometimes it does take some work on the front end to really understand who that person is and what their interests are and their history. With this, I'll just pull up a quick view that we often uh, give to universities when we're doing seminars on campus, of just the landscape and type of investors that you should be thinking about for your early stage academic startup. And as I said before, there's just a huge range. Starting at the bottom uh, to the top. These are kind of the progress of sources of funding that you can be thinking about. And this is not an exhaustive list. In fact, I think this list may be 4 or 5 years old. So with the rise of a tremendous amount of capital in the venture world, there's so many more logos on this page. With the growth of startups, there's so many more accelerators out there. and also at the lowest level, many more opportunities for grants and non-dilutive sources of capital from government agencies that are trying to become more involved in startups. But I just wanted to go through them, and I'll hit a couple of these in more detail later. But at the grant level, sometimes people rush to get venture capital, and don't forget that venture capital is dilutive, and we are investing in your company so that we can own a part of that company and share in the company's success, and hopefully be helpful along the way. And when you try and raise venture capital too early, sometimes you'll be able to raise it, but it raise the money, but you may not necessarily have enough risk retired so that you can get a valuation and an investment that is representative of all the work that you put into the company in the past. And so sometimes you may want to think of what are the non-dilutive ways that you can receive money to continue the work that the company is setting out to do, and increase your valuation so that when you raise $2 million, let's say, it's not at a $4 million pre-money valuation, but a $10 million pre-money valuation. And I'm not going to go into the specifics of venture capital economics, but just think of 2 on 4 or 2 on 10 as a certain. I'm buying a certain percentage of your company, and the higher your valuation is, the less of your company that you're selling. And so those grants are something that university professors and researchers are familiar with getting, and I think they're really valuable sources of early investment, non-dilutive investment. And then also some startups do leverage the kind of angel and friends and family world of people that have high conviction and confidence in the team involved and people, and they just want to support you in your efforts. And those are ways that you can get the early start from your company, and raise dilutive capital. Although I'd suggest when you think about taking money from friends and family, that you don't let them price the round. You don't let them set the valuation. One, it just creates a potential conflict, and also it's likely that they're not necessarily professionals uh, as an investor, and won't have an easy time pricing the round. I'd also say there's a growing area of venture philanthropy, research foundations that are interested in uh, using their resources to fund startups, instead of just giving grant money, but fund startups so that in success they're actually getting uh, capital back to themselves that they hope will fund more investment later. So there's a growth in that space, particularly in the life sciences. And then I think the accelerator incubator world is something that everyone's familiar with. In the university spinout space, I've found that accelerators are often less about, because they're broad, they're not going to be specific to university academic research. They're more about your exposure to uh, other potential investors, growing your network, versus uh, a great leadership at the accelerator that knows how to spin out a company in semiconductors or some other deep tech space. However, some of those are growing. Indie Bio, Silicon Catalyst are ones that are very tech focused. Nucleate is a similar one that's growing in Boston. Now, all the way to the top, the venture capital funds. These are the funds that are, you know, have 200 to $5 billion that they're looking to deploy into startups. And when you think about working with them, you do want to think about the right stage, and I'll get into more of that later. But it does have a very varied range of investors that you should be thinking about, all the way up to strategic investors. These are corporates that you are often working with as academic researchers, who can give you grants at the university lab, but they're also starting to get in the game of investing in companies themselves. So just a quick kind of view um, of VC by the numbers. And this is just sort of meant to be a reality check of what to be thinking about when you're speaking to investors of any sort, whether they're angels or venture capitalists, is that the majority of startups don't necessarily require venture funding, and they won't get it. A lot of businesses don't necessarily need 30 to $50 million of dilutive capital to generate revenue. oftentimes startups out of universities are fantastic small businesses that can become great companies for 15 to 30 people. And those are often companies that serve the the DoDs of the world, or the NSFs or the NIHs, the ones that can really kind of build a sustainable business just on continual grants and uh, uh, subcontracting to prime contractors like Lockheed Martin, where I came from, and other big companies, all the way through more kind of bootstrap businesses that already kind of have a product built and they just need to start selling it. And that's something that's just to think about is, you know, unless you have eyes on becoming a 500 million to billion-dollar valued business, it's not necessarily the right story to raise venture capital. But when you do have that kind of business, then you do need to go out and try and raise the money for it. And the mindset of venture is, we look at hundreds of businesses just to make one investment. And our the complex path that we have is, you know, building a story both within our own minds, but also in our partnerships' minds as to what becomes an investable deal. And even though you may eventually raise capital from fantastic investors, does not mean that another fantastic investor is going to want to invest in you. So VCs pass all the time for a variety of reasons, some of which are rational and some of them are irrational. But when we look at our database of companies, around 7,000 companies that we've tracked over the years from universities, we only have made 40 investments in each fund, roughly is what it is. So it's a really low acceptance rate. And it's just something I'd say, like, don't take it on the chin uh, when a venture investor passes on your opportunity, because you never know when you might want to go back to them, or they might have a different viewpoint in a year or so, and they may be interested in your next round. This is kind of just a different way of looking at our how we think of our pipeline and the process. So this deal flow at the top, the deals we consider, uh, this is kind of this I want to run through the pipeline of how we look at deals. So we'll speak to many companies and evaluate. Maybe they send us a pitch deck, maybe they send us a blurb, maybe we're evaluating their website or their research, and we'll meet with around 30% of those that we speak to, and around another 35% of those we kind of expand it to the team. So there's always a triage level within every venture fund that goes from kind of a junior level to a broader team level, and when you get to that broader team level, there's usually a decision right after that too of, well, do we want to dive in or not? And around, something like this is all data from our deal flow analysis. Around 50% of those that we bring into kind of a broader team level end up doing due diligence. And diligence is where we're spending time talking to your team more, you more, some of your customers, or some of your uh, you know peers in the field at the early stage of your company, trying to understand the preeminence of your research. And if we end up being very positive on that diligence, we may offer you a term sheet. And a term sheet is where we say in a non-binding way, hey, we would love to invest $2 million into your company at a valuation of $8 million so that we can own 20% of your company. Does this sound agreeable to you? And we all get happy and sign off on the term sheet. And then different firms do different things thereafter, but it's just non-binding, is what I want to make sure is clear. And it's around 60% of those deals go from term sheet to a closed deal where the startup actually ends up with the money that was offered to them. And so this is a very low probability process. And so oftentimes, what I suggest to startups is that you really kind of cast a wide net and you talk to many investors. And that does two things. One, it increases your probability of closing, but the other is it helps create a pace on the round. There's like a common aspect of venture capital, but really it's across the entire investment stack of FOMO, like fear of missing out. So it's if I know you're only talking to me as an investor or one other investor, I can pace my diligence accordingly. But if you're talking to multiple investors, you just create more momentum because I want to make sure that I can get through my process quickly in time to either give you a term sheet or be a part of a round that may be coming together with another investor. So, it's like how you get that first conversation with a venture investor. We look at many pitch decks, and so anything that you can do to rise above the noise level is important. And this is probably similar to what many of you all uh, deal with in getting grants. And if you have a startup doing SBIRs, like there's this term I used to use in the DoD world, like you want the RFQ to be wired for you, the RFP to be wired, and that means you've probably done some pre-work and you've tried to uh, build a relationship with the decision makers beforehand. In venture, that's there's two ways to do it. Is you have people that in venture, and you ask them early on just to hear your ideas. You're not asking for money, and you kind of make it a relationship because investors like to invest in a line, not a point. We like to have multiple interactions with people before we invest, and so it's good to get that level of relationship building. But the other is to just be introduced to a venture fund from an advisor or a friend, because that's just that slight little bit of elevation in our mind. That being said, that's like a very insular view of how venture works, and oftentimes, as is the case now, startups and venture. It's a seller's market. Startups have a lot of the power right now because there's so much capital in the market, and it's important to know that you have some power because investors are looking to deploy capital, and there's lots of competition to do so. And so investors nowadays, we always have, but some investors are taking more cold calls and cold emails than ever. And so don't be afraid just to reach out directly. So from a pitch perspective, as many of you all may be thinking about, a lot of you on the call, I imagine, are scientists if you're on this call. And that's fantastic, and it's great. It's also important to think about, is there someone you can bring in early on that's more of the entrepreneurial person involved? And as you're pitching, uh, you don't always have to have both. It's good to have both the business-minded person and the scientist. And if you're the business-minded person, and you're pitching to an investor, they'll often know that we don't expect that person to be deep in the details of the science and technology, and that we really want them to be focused on building the team out and what does the product look like, not the technology. What's the product? And what are the kind of unique insights that they brought from their previous experience in the market to say, okay, this technology, when it becomes this product, can really sell. And that's the really important thing, that unique market insight and view of the opportunity space. And also, how they plan to go about fundraising, and whether that entrepreneur has raised capital before, or whether they've been involved in successful startups before, is really important. And that knowledge of value creation, because value creation often isn't just achieving a technical milestone; it's generating revenue, or uh, hiring a fantastic chief strategy officer or chief product officer. Those are the things that investors often look for, that researchers sometimes just haven't had the full appreciation to know because they haven't been involved in a startup before. Um, but when you are just a sole technical team going after venture capital, play to your strengths. You know, focus on the science that you're building, and why it's special in the landscape of all of your peers in the community that are also working on similar science, and particularly in the life sciences space, really show the strength of your data. Our life science team, I think I have a slide on this later, but our life science team is very much science first. If the data is not good, then they do say, okay, it's not worth the risk because there's so much good research going on out there. And while we don't expect the academic team to fully have uh, the experience and knowledge to say this is the product we want to build, we do like to invest in companies that are building products. And so, you definitely want to show that you've thought about a multitude of opportunities on the product, and an openness to you know using your venture investment to pick the right one. And it's not just about showing the technology, but showing the fact that you actually know how to brainstorm on products. Um, So the just two quick things I'll mention on raising capital. You want to make sure you target the right investors, and the aspects of picking the right investor for the stage and sector that you're in is obvious. but it is surprising how often, you know, I get an email from a therapeutic startup or a medical device startup who probably could have looked at my bio page and known that there's 4 other people on my team that are more appropriate for that email. And just showing that level of work is something that I think is really important when you do reach out to investors and do try and pitch them, because we do our homework on you as much as we can before a call and learn about your background, and we want to ask you questions and we do look at your research. So just showing that similar level of effort is important. And also, you know, the you know thing you have to be aware of is fundraising is not fun. And it's a fantastic. Venture investors go through it when we raise our own funds, and it's a good reality check. But it is grueling. It's exhausting. You're going to get a lot more no's than yeses, and it's very unpredictable as to what happened, like why funds say yes. And so just be prepared for rejection. And oftentimes I think of, like, when I do have to pass on a deal, I try and give a thoughtful response. And I love it when the entrepreneurs and uh, founders come back to me and just to handle it like a pro. Like, they just say, "Thanks, let's revisit this later." And I do like to revisit this later. Our fund in particular, but many other funds do think about tracking companies over time. And if it wasn't right for a seed investment, it may be correct for a Series A investment. Um, the last thing I'll mention is, every so often in the university spin-out space, uh, academics or researchers think that the fundraising is just a function, and it's a outsourceable um, job. And there are many groups in the finance community that will loom around university campuses and say, "Hey, we'll raise you money. We'll raise your money for you. You focus on the technology and the build out, and we'll just take a commission on the sale, and you don't have to worry about anything." Ultimately, the types of companies that we want to invest in are not companies that can raise a couple $1 million through an agent. It's we want to invest in the companies that can raise a couple million from us, 10 million from another investor the next round, 50 million from another investor, 3 or 4 or 5 years down the road. And so we need to believe that the founders and the team can do it themselves. And so at the earliest days of starting your company, learn as much as you can about the fundraising process. And if you don't like the idea of fundraising, or you don't necessarily think you know how to do it, think about hiring a co-founder or an early executive that has experience doing it, and bring them onto your team, because it is an incredibly important part of running a company. So just thinking about time, I'm already going slower than I expected. And I'd say, I'm always happy to share these slides. If anyone wants them, please email me and let me know. This gets to the knowing your investors and knowing what stage your investors are at. There are company formation investors. This is for a life science view. Uh, Investors that are in the university, embedded, reading papers, pulling out interesting research opportunities, and saying, "Hey, I want to help form your company. I've got an entrepreneur over here that can help brainstorm the build out of the company, and we'll go from there." And those are funds like Third Rock and Atlas and OrbiMed, along with what's classic venture right in the middle, preclinical, raising $50 million, all the way through some of these crossover investors that will invest just before an IPO. There's a similar range in the tech world for investors that are investing in physical sciences and software. Uh, Lots of efforts in company formation and just regular venture investment for seed, Series A. I would say the difference between tech and life science formation investors is that oftentimes on the tech side, we do expect and want the researchers to be involved in the founding of the company. Like, it's just impossible to take IP out of a university lab and think that someone else is going to be able to polish it and turn it into a product. We do really believe, I believe, that a professor or a grad student who are the innovators behind the nuggets of technology should really be involved in the company. Doesn't mean they need to be the CEO, and oftentimes they don't have to be, but sometimes they are the right people for early on. And so when you're forming a tech company, let's say with a venture investor, you should have that expectation that you're going to have to do work with it, with the company. On the life science side, oftentimes you can take that early IP, because there are so many entrepreneurs out there who have built drugs off of just a kind of target um, for a therapeutic. So, Lauren asked me to sort of talk about the very first dollars that you would raise. So, as I mentioned before, dilution is not always the first step. You don't always want to take dilutive dollars as soon as you can because you won't get the valuation you want. And so, think about ways to, play to your strengths. You all know how to write grants. You know how to build proposals. You know the people that are involved in uh, awarding dollars to research efforts, and so definitely leverage those. And also, many of you, at least on the physical sciences side, are probably used to DoD and DOE funding efforts, and these groups are now all starting to build their own startup strategy. They have groups like AFWorks and DARPA aligned with InQtel to build this Emerge group that's going to be funding not university, but funding very, very science heavy startups, as well as Activate, which is this hybrid incubator accelerator. The other thing I'll say is, when you think of angel investments or uh, introductions to the right types of investors for your first, let's say, $500,000, make sure you leverage the network in your own backyard. Universities have no shortage of startups that have hit large fundraisers. And we've tons of data on successful university spinouts and unsuccessful university spinouts that have raised from really fantastic investors. And so do speak to your academic collaborators who have raised money for their startups before. It's really important to leverage their network and their experience for those early introductions to investors. I'd say also many of you receive corporate uh, research grants, and those corporate efforts now all have their own venture funds, and so they're historically been later stage investors, but nowadays they are moving earlier and earlier. So I've seen groups like Intel and Samsung and Merck do seed stage, pre-seed stage investments. And lastly, just as a shout out to a lot of the university efforts that we work with, tech transfer offices nowadays are becoming tech and venture offices. They have resources and both resource in expertise and resource in funding for translational funds and connections to angel funds that are local, and some are attached to the university. So please, like, make sure you go to your tech transfer office because they will get you up to speed very quickly if this is your first time. And they're not asking for anything. They're all always very happy to share advice, and their mission is to commercialize the technologies that you've filed disclosures on and patented, and so they benefit when your startup starts because that's a license for the office. And lastly, fundraising is going to be a challenge, but it's not the hardest part of building a startup. It is going to be a grueling effort, and so make sure you stretch out of your comfort zone. Do cold emails to people you don't know. Reach out to experts or people that seem interesting on LinkedIn that you're loosely connected to just to learn from them because you're going to constantly be out of your comfort zone as you build this company. Um, that kind of goes with this like scrappiness and grit. We definitely want our early stage investments, your first $1 million or so, we want it to stretch a long way. Lastly, these accelerators and incubators that are popping up, they're not going to be this hub of science and innovation. They're going to be about, style and substance and networking and connecting to other startups and learning from them. And in some ways, they're great because you can pause. You should be pausing your research and focusing on fundraising and product building and market identification. And so, while none of them are perfect for university spinouts, they do kind of help you step away and say, okay, what really matters to building a startup? And it's not just about the technology. I was looking at a question here. So one question is, which top 3 to 5 university innovation and licensing lab programs demonstrate the most maturity in the US as feeders for university-focused VCs? Well, so this is a really interesting question. So I think it's obvious to point to the coasts and say that the universities on the coast in Boston and the Bay Area attract the most venture attention. But they're also really fragmented because the community takes care of itself. And so there's so many venture investors in those networks, walking the halls, talking to professors and grad students, uh, kind of meeting groups where researchers and investors and entrepreneurs collide together. That those hubs in Boston and the Bay Area kind of take care of themselves, and so there's a lot of uh, um, work being done at universities in the non-hubs to build venture centers to handle some of the gaps that exist there. So I don't want to call out any specific universities, but I can say that some of the best venture offices at universities aren't necessarily at the ones that are producing the startups that raise $500 million. And so the resources are spread, and the resources um, that I think have been the most interesting have been some of the ones that recognize that they need to help their researchers get out, and they build really impressive mentor and residence programs to help their startups do so. And some do it basically just pro bono. And so, I can talk offline with anyone about that. This is something I definitely want to hit, assuming we have time. So, starting your company, and when three or four founders come together at a university and everyone is really excited about building the company, oftentimes the worst thing you can do is say, well, we're four people, let's split the company up 25, 25, 25, 25. And the reality is that is probably not representative of the contributions that occurred to the technology before the spin out, and it's definitely not likely to be representative of the future contributions that each individual may make to the company thereafter. And when you think about building your startup and rewarding or allotting equity to your co-founders, it's important to reward for past success and incentivize future success. And so oftentimes, if you're a faculty member starting a company with graduate students, as often happens, there's a lot of thought into, wow, this has been decades of research, and so much of your life has been put into this, and and you can't leave the university, and so there's a balance. Like, you just can't you can't necessarily expect that the past is all that matters when you're starting a company, because it's also about the future. And so when we think about this, um, it's important also to realize that there's other people that need to be hired, and that there's also the really important role of who is truly going to lead the company. And it's very rare that multiple people can truly lead the company and be exceptional at the important things of running a company that are solely non-technical: fundraising, financial planning, uh, customer outreach. Those are all things that require a very multidisciplinary person, which many researchers are. Uh, and that's why when we invest in a company, when we look at who's involved in a company, we do like to think of who's leading the company. And it can be the academic researcher, especially in the first couple of years. It does happen that way. But it's also great to think of someone who can come in with that experience, because they're worth it, even if they have a non technical background. And so when you form your company, do think about who is going to be leading the show. And that person, it's obviously hard when you have multiple people involved, but they probably deserve a disproportionate amount of equity. So we, roughly call that a 40% pool. And then other people involved um, may, have to share a smaller part of the pool, that remaining 40%. Oftentimes, you should also be thinking about, you're not going to have that founding CEO early on. And so you want to reserve a chunk of equity in your mind for that person later on, because to incentivize them to come when they're not going to be able to, get a high salary. Like, most people in startups do not receive high salaries. You need to incentivize them with equity. There's a question here. It's how do you pick the right non-technical co-founder? Um, when we look at the people at the executive level of a company, from an academic or scientific perspective, we do look at not just their academic, you know, superiority in the space. We look at their ability to hire people, and whether they are, fantastic people to work with, and whether we can imagine working with them. And if they're graduate students, we look for this kind of hunger of knowledge and excitement to learn about new spaces and identify markets because we take for granted that your technology is superior. When you think of the non-technical CEO that you may bring in, first off, that person does not have to be a CEO. They can be a VP of product or a chief operating officer or just a co-founder without a title. But we look for people that have, for one, the things that matter, just to be blunt, have they raised capital before and have they made the people who have given him or her money, have they made them money? So have they generated returns and do they know how to raise capital? But also, do they kind of have a unique market insight and do they know how to build a startup? There's definitely something to be said for really experienced industrial people from, like, let's say Fortune 500 companies coming in to help start a university startup, but nothing beats just that raw uh, experience of building a company. There's a question here. Do VCs who invest in academic spinouts only invest in companies with patents? What about companies based on software or other IP that might not receive a patent? So the answer is no. I mean, patents are important. There's very few funds are like ours that we only invest in university spinouts. Um, I think you hit the nail on the head. A lot of software companies don't have patents, and I think right now the biggest university startup I can think of off the top of my mind is Databricks, and they are a massive, massive company, tens of billions of dollars of valuation, and they open source their entire software stack, right? So they built Spark and built a company around that. And so you don't want necessarily to have. Uh, there's not always a story around patenting, but you want to think of a moat. Databricks' moat was the open source community they built that just no one could pull away from because it was such a sticky software product. But oftentimes in the life sciences, patents are everything, specifically around drugs. And in the tech side, it's also incredibly important because it builds acquisition value and downside protection. So uh, I think the reality is investors like to see moats, and patents are incredibly important for that. And software, sometimes you do need um, some protection around what you're doing. And that's a long conversation we've given presentations on before. So just wrapping up founders equity, we scan through our portfolio of 100 companies. By no means 100 companies cap tables. These are the data that we kind of tried to summarize of what's the right founders equity distribution for startups coming out of universities, given the variety of roles that you may have. And our 100 portfolio companies are biased because they're the ones that we chose to invest in. Doesn't mean they're good companies, but it's representative of what we like to see in cap table structures, equity structures, in investable companies. Because if the key is if someone is on the cap table, let's say with 60% ownership, but they're not working an hour a week at the company, that's like they're not working at the company full time, I should say, that's bad. And so that can kill a deal. Um, so when you think about things in the academic perspective, I bolded these two because it really breaks down to two categories for academic scientific founders. Um, are you going to leave the university or not? If you're a graduate student, are you going to go work for Google or are you going to commit full time to working at the startup? And so when you're a founding scientist who doesn't plan on taking a role with a company, maybe you're an advisor or just kind of providing connections and HR or hiring talent from your lab. Your inventions were critical, but the blood, sweat, and tears that are going to be a part of building the company, you won't feel the pain of. And so we really think of those personalities as kind of a 1 to 5% equity holder at the early days of a company. But if you are going to be working full time at a company, or potentially if you're a very kind of well known academic researcher who started multiple companies before and you're going to work 1 day a week at the company, it's kind of in this 20 to 25% category. So that's just something we look for in the cap tables of the companies we invest in. And oftentimes, university spinouts do have a wealth of IP that the university has invested in, and so the university licenses that IP to the startup. And because of the resources they put in, I think of oftentimes universities as the earliest seed dollars, whether it was a startup package for the researcher at the university or for the dollars they put into patenting, they should be rewarded for that. And so they sit on the cap table too in some ways. And And oftentimes there's different ranges in that for various reasons, but universities should be expected to kind of have a 2 to 20 to 30% equity role. I often say it's like in the 2 to 10 range. There are extreme cases where universities have put a tremendous amount of resources into a technology. Um, there's a question on do VCs care about the level of university ownership? Uh, yeah, I mean, sure, absolutely. It's another entity on the cap table, but as we can say, there's now thousands of startups that have spun out of universities, and just the fact that a university has equity in a company is by no means uh, ever stopped the deal. And so it's really about what's right and what's equitable, and it's a negotiation. But I'd say universities, and we've been a part of this and working with tech transfer offices for the past 12 years, have just learned a tremendous amount of what's fair and what's right. And it's a negotiation that is has lots of knobs. It's not just about the equity. There's also royalty and upfront payments. And the thing I often tell startups is, and tech transfer offices, they can't drive everything up, and startups shouldn't really think about driving everything to zero because that's not fair either, and that leaves everyone disappointed. Uh, this is kind of a takeaway slide since we're running out of time, but the key thing here for you to think of is you will not be able to build your company unless you accept dilution. And so when you think of starting your ownership in a company with 60% for the founders of the company, over time, if you've raised tens of millions of dollars, you may, across all of you, own only 24% of your company. And the most important thing you can do is think about it in this way. It's, do you want to own a small piece of a very big pie, or do you want to own a big piece of a small pie? And historically, the most life-changing financial events are when you own a small piece of a big pie. And so to do that, you need to raise capital, and you're going to take on dilution. Other people are going to have some level of control and involvement in your company, but investors aren't here to take away control. We're here to provide resources. And so, and get rewarded for that as a part of the exit of the company. And so the biggest thing you can do to increase the amount that you own in your own company at the end is by increasing the valuation of your company at each round. And so that means making the most of the $1 million you raise so that you can become worth well more than $10 million at your next round. So I'm going to stop here um, and completely skip the slide that we were I was gonna slides that we were going to go through on pitching, and leave you with this slide, which has my email address, and just kind of quickly scan for questions. I think we probably have a minute. Um, what funding recommendations do you have for companies that forecast only moderate growth? I think this is a really good question because uh, lots of startups don't have the explosive growth of enterprise software. And I'd say there's an investor for everybody. I think there's a college for every high school student. I think there's an investor for everybody if you believe you can grow. And so really focus on investors in that category. There are philanthropic investors. There's clean tech investors now. There's nonprofit investors. And so really kind of, if you don't think you have an explosively growing company, you just think about creative ways to find the right investors for you. And there's also debt opportunities too. So don't necessarily think about venture. You might be able to access, it's called venture debt. I'm just going to scan through, I guess, until we get cut off. What are some of the indications that you should license rather than build a company yourself? How and when should I make that decision? I think this is a really great discussion to have with your university tech transfer office. It's something I think about often when I'm helping tech transfer offices just evaluate proposals and IP, because not all technology really can make it to market as a startup. And some of it just comes from not whether the technology will work or not. It's more of how accessible the market is with the products you think you can build. And so I really just think it comes from a really deep thought experiment that I'd love to talk to anyone about this. They can email me. But not all IP should necessarily be a startup. Is what I'll leave you with. So I want to thank everyone. And really do feel free to email me. Thank you, Lauren and Princeton, for setting up this conference and giving me an opportunity to talk to you all. Thank you very much.